Hello. 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 Am I audible?
I am audible?
Yes.
Okay.
I'm
Mute.
visible. The angle is proper.
Pardon?
Am I visible and the angle is proper?
Everything is perfect. Just 2 minutes before on your video and audio at present, you can.
Okay.
Jitesh, are we already live? Hedoy, are we already live? Hedoy?
Yes,
Yes,
sir.
sir.
Okay.
Yes, sir. We are live in YouTube.
Okay. Thank you.
Is the screen visible? Can I ask someone? I have
Yes,
shared
sir.
my screen.
Yes, sir.
Yes, sir.
Great.
Yes, perfect.
Great.
A very happy and cheerful morning to all. On behalf of Bansanga's Umakrishna Shetty Institute of Management Studies and Research, I welcome everyone to our international webinar on recent developments and future trends in banking sector. Before we start, I hand over to our director, Dr. Krishna Shetty, to say a few words on this occasion.
Good morning, everybody. On behalf of Band Sangha's Uma Krishna Shetty Institute of Management Studies and Research, popularly known as UKS, I welcome you all once again. Just a few words about us before we begin with the actual seminar. Our parent body is Band Sangha Mumbai, whose foray into education and higher education ranges to more than 3 decades back. We began by starting 2 night schools for the challenged students in Mumbai, and then we went on to start higher education institutions. We have 2 parallel setups, one at Powai, where we have more than 6,000 students studying in various verticals, and we are based at the Kurla setup, where we have more than 3,000 students. UKS is a MBA college, it's a B school. We offer PGDM and with various specializations. Band Sangha Mumbai is headed by its president, Sri Padmanabha Payyade, and the higher education committee, which takes care of the Kurla setup, has Sri N. Vivek Shetty as its chairman, and all the other office bearers who put their heart and soul into seeing to it that the students are well taken care of and we make a difference in not only their careers but also their lives. Our endeavor, especially in these times of lockdown, has to be to bring to you all, to the general public, to the students, to the academia, and to the industry people, various webinars and sessions which will give you some value add and set you all thinking as to what is the right way ahead. In this direction, we have organized today's webinar, recent developments and future trends in the banking sector, and we have a very, very esteemed speaker with us, CM Manish Sampat. And I would like to hand over to our Professor Shalu Purswani, who's heading our IQAC cell. The IQAC cell is organizing today's webinar, and she will introduce our esteemed speaker for the day, CA Manish Sampat. Shalu, over to you.
Thank you, sir. Good morning, everyone. Welcome you, Manish, sir. Manish, sir, is partner at CNK Associates LLP. He is a commerce graduate from Mumbai University and a chartered accountant in practice from last 25 years. He has joined CNK and Associates as a partner by merging his individual practice. Currently, CNK has total staff of more than 500 people and has offices all over India in Mumbai, Baroda, Chennai, Bangalore, Pune, Ahmedabad, Delhi, and Dubai. He is a part of audit and assurance practice at CNK, and he specializes in various attestation functions of banks, foreign multinationals, and new age businesses in the service sector. He has also handled statutory audits of several large banks, listed entities, foreign companies, large private companies, and he has also handled audit of Reserve Bank of India during 2013 to 2016. He has a lot of experience in valuations and due diligence. He is part of study group appointed by AASB of Institute of Chartered Accountant. Manish Sampat is currently the president of Bombay Chartered Accountant Society and has worked on its managing committee and various other technical committees. He is also co-author of 3 publications on accounting standards and standards on auditing. He is secretary of Audit Committee at Cricket Club of India Limited. He was past managing committee member of Western India Automobile Association of India. He was faculty at HR College of Commerce and Economics for many of its professional courses. He delivers a lot of guest lectures at various management institutes. Over to you, sir. Welcome you, sir, again.
Thank you. Thank you very much. First and foremost thing, thank you to Dr. Shetty. Thank you, Shalu, for these kind words. And it's a pleasure to be here with all of you. And today I'm here not because I'm an expert or I'm not an expert in the industry, but just over the years, I've got an experience as a customer, as a user of the banking industry, and as an observant, I'm here. And since the past about 20, 25 years, I've also been doing audit of banks And plus, I follow this industry very closely. So with this background, I am here. Friends, all of you all know today, I don't want to say that we are in about our past 50th day of our lockdown. And India currently is handling two curves very delicately. First curve is of the infected, COVID infected patient curve. And the second curve is the the growth curve in the economy. So there are these two delicate curves which just now India is, trying to handle. And we would love and wish that the curve of the infection gets flattened and maybe falls down, but the curve of the economic growth and the curve of the economic prosperity and the growth comes back and rises again. Friends, never ever in our in our dictionary, we never had words like lockdown, social distancing. In India particularly, these words were never heard of. But friends, with every night comes a beautiful day. With after every sunset, there is a beautiful sunrise. So there is a lot of learnings from these lockdowns also. Along, if we have added words like lockdown, and we've added words like social distancing in our dictionary, we've also added words like Zoom and Blue Jeans and other video conferencing apps like that. And I'm sure with the response that we have got, and I'm also heading the Bombay Chartered Accountants Society, and we are a 70-year-old organization where we have 9,000 plus members, and we do all voluntary work, and we are in the work, work of only, like how we all are in spreading knowledge. We also spread knowledge, but our field is limited to chartered accountancy. And we also try to do programs which is influencing the general public and CA students at large also. Sorry. So friends, had it been a physical meeting, getting so much response to the particular, or maybe registrations for this conference would not have been possible. But only because of this lockdown, everybody is looking at upgrading their skills. Everybody is looking to learn something new. And with this endeavor, we are getting so many positive responses. Uh, we all, as I was telling you, that all of us have learned in this 50 days, we have all got used to this new normal in life. Is it going to change ahead or no? It's only time can tell. But friends, all of us are getting so used to, working in this type of environment. Like I used to, sometimes charge my mobile phone once in a day. But now at times, if the work schedule gets so busy that at times I have to charge it 3 times in a day. So with this background, I think so I'll just come to today's session. And when this particular session was told to me uh, on talk about the challenges or the recent developments in the banking industry, so I immediately accepted it. Now, friends, the importance of banking sector or the banking industry cannot be undermined, because according to me, the banking industry or the banking sector is a backbone to the full economy of any country. And friends, to understand that, what let us just get into a little bit of a background, that what is the business of the bank. What does a bank do? uh, the business of a bank actually is to deal with money. So that's a very sensitive and a very delicate topic, because it deals with money, and more importantly, not only its own money, but it deals with others money. So what does a bank do? Actually, it takes deposits, or it takes money from us, people like us who want to do saving, and then it gives it to the industry, it gives it to the business. So therefore it is in the business of taking deposits and giving loans. Plus, it also facilitates business transactions, payment facilities. And these are the main hardcore business of a bank. And along with that, it also does other allied activities. Now, friends, you can see from the chart that I have shown over here, in India particularly, the top 5 sectors in the Sensex that includes is about 42%, it includes financials. So majority of that comes from banking industry also. Yes, there are certain NBFCs also, but majority of that comes from the banks. The 42% of the index today weightage comes from banks. And also, if you see, compare that to the West in the Dow Jones Industrial Estate, the banks come a mere 15%, three, it's the third in number. And also, if you compare the market capitalization in USA is about 2.3 trillion US dollars today of market capitalization, and it has about 865 listed banks. So this is the importance of the banking industry in the growth of, or in the economy of any country. Friends, besides lending money and besides accepting money, what does it do? It channelizes household savings. It serves people like us who want to save money and save money, keep it into the bank, and then it also facilitates business, as I told you. And more importantly, in recent times, the banking industry has come more into forte because of two particular developments that recently happened. The first was of the demonetization. What happened in the demonetization is that a lot of money that was lying in cash came into the banking system. So therefore, the banking system became robust. And secondly, the GST. What happened because of GST? The total unorganized business slowed down. The unorganized business started going down, and everybody started moving on to a platform, a more organized business. So therefore, the flow into the system increased. So therefore, these were the two important factors that led to the increase of the banking industry in India. Now, friends, when, today's agenda, what I have to talk today, what I have planned today is definitely for about 60 to 75 minutes. I will just speak to you on these various agenda items that I have listed out for you. And then after that, we will see if there are any question answers or how interaction can take place. So therefore, what I have thought today is that definitely the agenda would be the introduction and the background of banking industry, the banking services, because it includes, or maybe it affects all of us as students, parents of students, because we need to pay the fees, parents, maybe seniors who are staying abroad, we need to remit money, and all these three things come through the banking channel also. Right from the bank, a small shopkeeper, to the highest corporate, we all require banking services. So therefore, I'll just give you a brief introduction and the background, how the regulation works of the banking industry. Then definitely the importance of banking industry, I've already spent a couple of moments and I've already informed you. Then comes the recent developments, what have happened, and the recent challenges. In my view, there are these 4 or 5.
Sir, sorry to interrupt you.
Yeah.
Sir, please increase your volume. No, in YouTube, they can't hear your volume properly.
Okay.
Yeah.
Fine.
Yeah.
Now is it okay?
Yes,
Yes,
yes.
sir, much better.
Yeah. Okay. So then coming to the challenges and the developments which are happening in the banking industry, I have listed out the 4 most important challenges that we are facing. One is definitely the non-performing assets or the loans that are going bad. Then the huge amount of corporate frauds or the banking frauds that are
Sir,
affecting the
sorry to
industry.
interrupt again. Sir, I
Yeah.
think you will have to speak a bit louder physically.
Okay.
Yeah.
Okay. Yeah. So coming back to the banking frauds, there is a lot of frauds that are happening in the banking industry. Then the credit growth, the growth of the banks depends upon the people taking loans from the bank, and therefore there is a challenge in people taking loans, and there is also a challenge from lenders or bankers giving these loans because of the past experiences, because of the bad experiences of the past. Therefore, bankers are not willing to give loans, and borrowers are not willing to borrow the money. The industries are not willing to take money. So therefore, that is another challenge. Then coming to the capital constraints, because for every bank to grow, you require a certain amount of capital, but capital always is in short. There is always a shortfall for the capital. So therefore, these are the 4 important challenges that I foresee in the banking industry, and that we will talk about it in detail. Second thing is future trends. What is happening in the banking industry? The consolidation of banks. The government has already announced that the public sector banks will be consolidated and the number of banks will go down, and we'll have more stronger banks. Then what are the structural reforms and growth that are happening in the banking industry? And definitely we cannot ignore the topic of technology that are having, the new age banks that are coming, at what impact technology will be having on banks is also another important area that we will cover. And any topic without the regulatory policy or without the changes, what is going to impact in the post COVID or in the post lockdown is incomplete without this seminar is incomplete without that. So that we will be covering.
Sir, sorry to interrupt you again.
Yeah.
Sir, again, volume issue in YouTube, they can't hear properly. You have to take your mic in front of your mouth.
Okay.
Yeah.
Fine.
Yeah.
Okay, fine. So now coming to the introduction and the background. Now the banking business, as I told you, what does the banking business does? I have already explained to you what the bank does, what is the business of the bank. And now here it's very important to note that banks in India is very, very well and strictly regulated, because even if you see, the Reserve Bank of India has got complete hold over the banking function or the banking industry. Because also, if you see, in 2008, when there was financial crisis, the Indian banks were totally above board. The Indian banks were not affected at all, and therefore we came out with flying colors. And hopefully this time also, with the strict regulations that have been coming, Indian banks will prosper. So therefore, it is strictly regulated. The first and the foremost thing, it is regulated by the Reserve Bank of India, which has got its stringent rules that they follow to regulate the banks across the country. Then also, the banks which are listed also have to follow the SEBI requirements or the SEBI listing obligations. So therefore, they are also regulated by the Securities and Exchange Board of India. And friends, you also will know that there are certain banks which are private banks, like an HDFC Bank or a Kotak, ICICI. These are private banks. So since there are banking companies, therefore Companies Act also is applicable. So besides the other regulations, the labor laws and all that, but these are the three broad framework which are regulates the banks. So therefore, what are we talking about is that the Reserve Bank regulates, the SEBI regulates, there are provisions of the Companies Act that has to be taken into account. And plus, as I was telling you, Reserve Bank of India, how does it regulate the banks? The Reserve Bank of India regularly comes out with its policies, its circulars, it reports. So therefore, that has to be followed. Plus, the Reserve Bank of India has got a very strict system of inspection. They do audits of bank regularly. The inspectors of Reserve Bank of India are sitting on the heads of the bank to see how to monitor how the banks are functioning. Plus, there are certain an SSM is there, who is a representation of the Reserve Bank of India on the functioning of the bank. Plus, Reserve Bank of India has got its own nominee on the boards of all public sector banks. Annual inspection is there. So this is the way how banks are regulated. Now, coming to types of the type of banks which are in India, these are important, because right now the most important category of banks are the public sector banks. Right now, till March 2020, we had 18 public sector banks. But now, after the consolidation, after the government of India informed about the merger, now we have 12 public sector banks. So these are your various State Bank of India, your Union Bank of India, Bank of Baroda. All these where government holds more than 50% are called government banks or public sector banks, and these are what are called public sector banks. Then second breed of banks that we have are the most dynamic ones, and on the stock exchanges they have performed exceedingly in the last 10 years, and those also in operations are very effective, and also operational wise they are very competitive. Are the private banks, that are the ICICI banks, the Kotak banks, the HDFCs, the Axis banks of those types. So these are called private banks, because there the government of India might be holding some shares, but not in majority. They might be holding either sometimes no percentage, or maybe very less percentage. So these are called private banks. Then friends, so there are about 22 private banks as of today. Then there are these foreign banks, the Citibank, the HSBC Bank, etc., etc., the Deutsche Bank, Development Bank of Singapore. So all these are foreign banks. The foreign banks are in India by virtue of either they might be having a particular bank in a registered foreign bank, or they might be operating as a branch of a foreign bank. So that's the way in which they come. Besides these banks, there are also about 53 regional rural banks. So we also have regional rural banks because they cater to the rural, wherever the banking industry has not reached. So therefore, there are regional rural banks. Plus, recent additions to the bank in the past 2 or 3 years have been small banks. Small banks are typically, of course, I have a certain slide that I'm covering what are small banks, but small banks are those which do not get into large corporate wholesale lending, but they are specifically meant for retailers or retail banking. Their loan ticket size is very less. They get into more into retail loan. I will explain to you on what are retail loan and type of advances when I do. But corporate loans are those loans are huge. I mean, they are usually larger in size for capital investment that the industries or the corporates take. And retail loans are like retail loans like you and me would take: a car loan, a housing loan, an educational loan, and etc., etc. So therefore, these are these 10 small banks which are there. Then government has also given licenses to Six, payment banks. Payment banks means only they are restricted to about 1 lakh they can accept maximum amount, and from that they can only accept, I mean, or they are doing like e-wallets or payment like Paytm or Geo or Airtel. So these are called payment banks only. So the Reserve Bank of India has given them payment bank licenses also. More importantly, besides these type of banks, also we have urban cooperative banks and rural cooperative banks. So basically, they are not listed, they are not under the Companies Act, but they are governed by the Cooperative Societies Act. So therefore, they are cooperative banks. So those mostly in the rural areas, or maybe self-help groups, wherein a few people or the few community of farmers come together, they contribute money and start a bank. So therefore, these are cooperative banks. Cooperative banks, since they are more regional, more agricultural, and more district level banks, therefore they are not very closely monitored by Reserve Bank of India. So therefore, they are more prone to frauds, and we keep on listening to incidences of misuse of money in these type of banks. So friends, there are about 1,542 urban cooperative banks and about 95,000 regional rural banks. So these are the type of banks which are there in India. Now, more importantly, that what are the type of deposits? What are the We already know that what the bank does. The bank takes money from us, and we put money either in the current account, in savings account, in recurring deposit account, in fixed deposit account. So similarly, they channelize the savings through these deposits. So deposits are liabilities for the bank. And what are the type of advances? These advances, friends, whenever my dealing with the banks have been there, these are the foremost or the most important part of the balance sheet of any bank, because they form the highest amount of assets or the biggest amount of asset in any given balance sheet of a bank. Why advances? Advances is what? The loans that bank gives to the industrialist, the loans that banks are giving to us are all called advances, because and that is an asset for the bank, and they earn interest because we pay interest to the bank on loans taken by us. So that is their income. So their income also depends upon these type of advances. Now, what are the type of advances? Usually the advances are can be classified into 6 7 broad categories. One are on time basis. Some are short term, some are long term. So basically short term would mean, say, for a short period of time, 6 months, 9 months, maybe 1 year, somebody requires money, so therefore there could be short term. Long term loans are usually, long term advances are beyond 2 to 3 years, or maybe more than 1 year would also be called a long term loan. So therefore these are for for a particular project, a project loan, infrastructure loans. Those are longer period loans. Loans that we take for our housing, those are long period loans. So those are on time basis. Second most important classification is secured or unsecured loans, is by way of security. Now, whenever we are spending money on our credit card, the credit card company, the bank that is issuing the credit card, immediately pays to the vendor or the person or the restaurant or the shop where we have swiped in our credit card. So that becomes a loan for us and an advance for the particular bank. So whenever we are swiping on our credit card, the bank has never kept any security. He has not said that, okay, you keep a fixed deposit or you keep your house as mortgage or a loan. Against that, I'm going to issue a credit card. So these type of loans, which are usually called clean loans also, sometimes even educational loans are clean loans, or sometimes some personal loans are also called clean loans. And usually personal loans are unsecured loans, which come at a higher rate of interest because there's a higher risk for the bank. And other secured loans are those where they keep certain amount of an asset of the borrower as security. Then also we have classification of on geographical basis. That means loans which are originated in India or originated outside India or for export. So they are called classification through on geographical basis. Most importantly, we also have certain amount of loans which are fund based and non-fund based. Fund based means when the bank gives a loan to a money, I mean, gives loan by way of money to the borrower, that is called fund based. And certain amount of companies also take non-fund based. For example, of non-fund, best examples of non-fund based loans are, say, bank guarantee or performance guarantee. Say for example, an L&T is building the Worley ceiling, the Worley Bandra ceiling, and the government says, okay, you give us 15 years performance guarantee that this ceiling will exist for 15 years and you will not have a problem. So therefore, crores of money is given that in case something happens, the bank will make good that money, but that is contingent in nature. It does not fall into the balance sheet because actual money outflow is not there. But that is also a type of a facility that it gives. So these are non-fund based. Then most importantly is others are either demand loans or other than demand loans. And usually money that are borrowed on other than demand loans are those that it has a fixed maturity, that after 3 months, 3 years, 6 years, 5 years, 20 years, that money will come back. So that's a called a term deposit. And term deposit also are divided into, demand deposit, term deposits, etc. And within that fall most of our loans. A car loan, housing loan, all would form under a term deposit. But there are other facilities that maybe a trader would require, a business would require for its working capital requirements, for its current assets management, means buying inventory, selling till the money is getting blocked in the debtors. So those are called CC, that is cash credit or a temporary bank overdraft or a overdraft facility. So these are other than demand loans. Most importantly, again, some advances can be classified on sectors: priority sector, agricultural advances, advances for education, advance or loan given for starting a small business. All these are called for housing. All these are called priority. And non-priority, say to build a mall or to build infrastructure, also would be priority, as I told you. But non-priority is to build a hotel or to build office premises or to have an increasing your capacity of your manufacturing facility. All these are non-priority based. And then most important that we also need to learn is that what are the banking facilities that are offered today. The first and the foremost thing is a sole banking facility. Suppose if a big company wants to go and take a loan, and it takes loan only from one bank, and it has got banking facility only with one bank, it is called sole banking. Also, if it has a relationship with multiple banks, 4 5 banks together, not together, rather 4 5 banks, and it takes loans from all 4 5 banks, it is called multiple banking facility. And the most important, all huge, large, and big advances of more than 5,000 crores and all that, or even maybe less amount of that also, would call a consortium. So therefore, a consortium is 7 8 banks come together, and nobody wants to take the risk to give a large exposure to a particular borrower. So therefore, all these banks come together. Come together, and they lend to one borrower for one project. So these are called consortium. Naturally, you would have a head of the consortium and who would take the decision and then move forward. So this is the particular, the type of advances. It was important for us to know because we'll be dealing with this in times to come. Then the structure of the bank, I would say, is that there is the head office, the board of directors. Before that, there's a head office. Then there are central accounts departments, central departments, treasury, wherein they buy and sell investments. They monitor advances, they form policies. And then there are certain zones, and under zones there come branches. So that's how the full banking structure is figured in India. Then the accounting framework, as far as today, only the accounting standards that have been issued by the Institute of Chartered Accountants of India are just now applicable to the banks. Ind AS or IFRS just now are not applicable. The government is thinking about it, but it might come out probably after this particular situation dies down, or maybe in next 2 or 3 years down the line, we might have some clarity on that. The auditing framework, the Reserve Bank of India is include. As I told you, does audit itself. Plus, there are other independent auditors like us who do these audits. Then it is also important to know that what is the difference between banks and NBFCs. Banks, as usually was I told you, but NBFCs probably, as I told you, would mean say a Bajaj Finance or a Shriram or Mathut or something like that. So these are all NBFCs. So these are called non-banking financial companies. They also operate like banking companies also, only their businesses are like banks, but they are not banks. They have got a separate rule of, for them, a separate regulation for them. Then coming after that, then if you see the recent developments that are happening is that India actually, if you go to see, the penetration of banking industry was very poor. banking was not able to reach to the remotest of villages, and it could not reach to the remotest of places in India. So therefore, that was particularly an issue as far as India is concerned. Yet India's problem is that it has got a lot of money in parallel economy. A lot of black money was there. So therefore, India was not effectively banked. People were not using banking facilities. Plus, also the India was, a lot of unorganized sector was there. But after GST, that has come down. So
Sir,
therefore, the penetration.
sorry to
Yeah,
interrupt you again.
yeah, yeah.
Sir, will you share your screen again? Because on YouTube, they are just seeing introduction screen yet. Only they are on introduction screen.
Okay, okay. 1 minute.
Yeah.
Now is it fine? Just ask them. I'll
Yes, fine, fine.
I'll
It's
I'll
proper
proceed.
now.
Yeah,
Yeah,
yeah. I'll
yeah,
proceed. I'll
yeah,
proceed.
yeah.
So therefore, if you see that these are the recent, after 2014, after 2015, these are the steps that the government has taken. The Pradhan Mantri Jan Dhan Yojana, wherein affordable bankings were available, affordable banking services at a very, very low cost was available to the household or to the poor people. Wherein, if you see just now, as on today, the deposit amount stands at 1.32 lakh amounts, and about 38 and a half crore accounts have been opened. Then also you have the Atal Pension Yojana, which also helped to have pension in the unorganized sector. And then the Mudra loans which were there. Now if you see these three facilities, also if you see on the 13th of May, whenever Atmanirbhar Bharat, whenever announcements were made, direct money transfers in the hands of the poor were mentioned. So therefore all these accounts would go into these Mudra accounts, and the accounts opened under the Pradhan Mantri Jan Dhan Yojana. Mudra accounts are easy loans, and that ranges to the extent of 50,000 rupees for startups or first-time entrepreneurs, from 50,000 to 5 lakhs for existing businesses, and or those businessmen who wanted to expand, from 5 lakh to 10 lakhs loans were given without much of headache. Now, if you see this slide just talks to you about the strength of the banking industry so far, how the banks have moved. If you see the size of the banking industry, as I told you, yes, the private sector bank is growing rapidly, is more effective, but the main banking, the government push of the government, the reach of the government is going through the public sector banks also. So if you see, that's the size. And if you see how the banking, what has been the compounded annual growth rate of the deposits and the compounding annual growth rate of advances in the last 5 years has increased by about 11% year on year, and the deposits have increased by about 12% year on year. So this is how the size of the banking industry is there. Now friends, if you see, I would just like to spend a couple of minutes here. This is the full consolidated balance sheet. If you can see, this is the full consolidated balance sheet of the full banking industry in India. Extreme right, if you see the total size of the, and of course it is bifurcated into public sector banks, private sector banks, foreign banks, as I have told you. Extreme right hand side shows all banking industry, and this is the consolidated balance sheet as on March 19. If you see the total assets of 2000 of all the banking industry in India was 153 lakhs as in March 18, and which has grown to about 1,66,000 166,000 crores in March 19. So that's the total size of the balance sheet. Now, if you go to see, if you compare 18 to 19, the total size of the balance sheet has increased by 9%, which is represented by about an 11% increase in the advances. And advances are most important, as I told you, because advances is where the bank gives loan. And if you see, the deposits have grown up, which is coming on the liability side naturally, because those are the money that we have kept, has grown by 9%. And if you see the capital has grown by 33%. So this is the overall position of the bank. But if you see within public sector banks, the growth has been less, because if you see in the public sector banks, the growth has been in the range of 2 to 4%, and in the range and for private banks, the growth has been in the last 1 year since about 20 to 25%. So this shares, this shows you the importance of the private sector banks. Now, when we come to the non-performing assets, the first challenge that we are having. Non-performing assets are those assets or those loans which go bad, and those who stop generating income for the bank is called non-performing assets, the loans that are not likely to be paid. So then fraud, as I told you, credit growth also I'll be covering, and the capital constraints. I have got presentation on each of this particular stride, on each particular point. Now, when we come to non-performing assets, how do you determine? You cannot have a subjective criteria. So therefore, the Reserve Bank of India has come out with its own criteria, its own income recognition and asset classification norms, which just for the simple, simply to understand, if a loan or interest or principal amount is not paid within 90 days, that account becomes a non-performing asset. And non-performing asset would mean that those assets wherein you stop recognizing your income. Otherwise, say a person has delayed the loan even for 30 days, 60 days, the bank keeps on recognizing that interest. But once any borrower has not paid on that 90th day, then it becomes a non-performing asset. So I think so this is the broad category. I'm not going into detail, because going into this detail itself would mean about a 2-hour section only, 2-hour lecture only on this asset classification. So therefore, that's how the objective criteria is formed by the Reserve Bank of India, and this is followed across India. 90-day norm, that if interest or principal amount is not paid within 90 days, the account becomes non performing, it becomes an NPA, and the bank stops recognizing income on that particular account. Then along with that, it also comes provisioning for simple term. Naturally, most of you all are commerce students or even understand business. Provisioning means you keep aside some amount of your profits, and provide that, if the account is going to become an NPA, or you have to keep on providing on stages basis. So therefore, there are various stages. If the account is a non-performing asset for 1 year, then there is a separate percentage. If it is from 1 to 3 years, it is a separate aging, and then 3 to 5 years, it's separate provisioning, and 5 years and above, it's a separate provisioning. So therefore, these are the provisioning requirements. So an account, when it becomes bad, so that the stress comes on the particular banker or the lender, because if you, and I always say that the bank's balance sheet is always a reflection of the industry, because the industry's balance sheet or the industry's performance sits in the balance sheet of each particular lender or each particular bank. Because if the industry does bad, and it's not able to pay the bank loan, then the bank's balance sheet weakens. So therefore, that's important, how the performance of the industry also influences how the banks perform. So therefore, there's a double whammy. Whenever an account is a non-performing asset, the bank has to stop recognizing income, plus it has to start provisioning. So it impacts profit in both ways. You increase your expenditure also, and you reduce your income also. Plus there was a particular jargon called restructuring, to prevent actual loans to become bad, or maybe bad loans to become worsen, to prevent we call it that whenever these accounts are non-performing, that means the patient is sick. But if it goes into after restructuring, then it goes into an ICU. That means the account cannot be bought back. So therefore, to prevent bad accounts from going worse or becoming loss assets, we have a concept of restructuring, wherein the bank sits with the borrower and tries to rephase its payment. It reduces its installments, it increases its interest, and it increases its payment terms, or maybe a maturity period. So therefore, these are called restructuring. Then there's an important concept also of called a prompt corrective action, which was introduced by Reserve Bank of India 3 to 4 years ago, and it is also always existing. By way of prompt corrective action, what does a bank do? A Reserve Bank does is that it prevents deteriorating of the conditioning of the bank. So it has restrictions on the bank, that you cannot open branches, you cannot give new loans, there's a freeze on the salary, etc., etc. So it ties up the banks of the Reserve Bank, of any bank, any bank that falls into a preventive correction PCA. Then, friends, I would, any discussion on non-performing assets would be incomplete without discussing this controversial circular of 12th of February 2018, wherein at that time the non-performing assets were at the peak, and the Reserve Bank of India wanted to address this very badly. At that time, it brought about this very strict circular that even if there is a 1 day delay in giving of, I mean, in a default, or there is 1 day delay in giving or repayment of the interest or principal, immediately within 180 days, the bank would have to take that particular lender to an insolvency or under IBC, or to initiate insolvency proceeding against that. So various industries, for example, power, textiles, approached the Supreme Court. The Supreme Court in 2019 got a stay to this, and therefore the revised framework came on stress assets, wherein that revised assets, in revised framework, all the non-performing assets were decided to, rather than non-performing asset, the attention was shifted how to monitor them from preventing it to be falling under the non-performing assets category by, having an SMA, that is special mention account. So therefore they categorized all accounts into SMA 0, SMA 1 and SMA 2. SMA 0 would mean that there is a default of 0 to 30 days. SMA 1, 0, that is SMA 1 would mean 31 to 60 days, and 61 to 90 days would fall into SMA 2. So therefore, there was a close monitoring of these particular SMA accounts. Then also for large accounts, which were for more than 5 crores, the Reserve Bank of India had a database of all the accounts which were coming into that, which was called CRILIC, which was, the central repository for information for large credit. So whenever there was a single day delay, you had to come, you had to put that borrower's name. Every bank puts that borrower's name into that central database of Reserve Bank of India. So that database is available across banks, so they can monitor all these large advances across the banking industry. Otherwise, to prevent a borrower to take loan from one bank and again go to another bank, and those misuse used to happen. So preventing that, so therefore this revised framework was introduced, and also a certain relaxation came as far as the insolvency and bankruptcy proceedings which were come. Friends, I'll just spend a couple of minutes on this slide. If you see, in 2000 till 2011, 12, 13, the non-performing assets was in the 4% category, and that was manageable. But after that, in the last 3 or 4 years, the non-performing assets in India, or in the banking industry as a whole, has gone up to about 9 to 10% of the total advances. And when you compare it with the economies, of the advanced economy, if you see, the first is Australia itself, which has got hardly negligible any non-performing assets. But if you compare, even the percentage of our percentage of 9 to 10% is high compared to even the emerging economies of Brazil, China, etc., Indonesia, Malaysia, etc., etc. So in the past few years, the non-performing assets have become a big problem as far as India are concerned. And these non-performing assets have only, because of large corporate failures. We've had, corporate failures like Jet, Kingfisher. Then you have Cox and Kings. You have, Monet Ispat, Videocon, Amtech, Jyoti Structures, Patanjali. You name it. JP, Ruchi Soya, etc., etc. So whenever you see, all these corporate failures have led to these non-performing assets to spiral bind. Here also, if you see, this is a close the movement of the non-performing assets. Here also, if you see, the total 15% gross bad assets of public sector banks is close to 15%, which is about 4% in private sector banks. So it says that the private sector, and of course, friends, just believe this, that this is before the Yes Bank happened, because this is for March 19, and Yes Bank happened after the March 19. It happened in March 20, and March 20 figures yet are not available with me. So therefore, this is before that. So therefore, if you see, what has happened is the gross non-performing assets, gross assets that are bad or non-performing as compared to the total advances, were close to 15% in case of public sector banks, which were close to about less than 5% in private banks. So therefore, that was the difference. But when you come to net performing assets, the difference between gross not performing assets and net NPAs is that net NPAs is after you provide for it. So for example, as I told you, suppose if a bank's 100 rupees is bad, the bank will not immediately go and ahead and provide for that 100% unless and until it's a fraud account or a loss account, etc., etc. It will have in phases, because chances of recovery are there. And as the loan or bad loan goes older, the chances of recovery reduce, therefore the provision amount increases. That is the logic behind it. And if you see, the net NPA for private sector banks is more than the gross, so therefore the provisioning is actually less. And if you see, the increase in provisioning as far as public sector banks is there, so the NPA is less than the gross performing assets. Also, there has been a lot of amount in this year, March 2019, a lot of corporate Bhushan and all were written off. The insolvency proceedings were there. Tata took over Bhushan, and etc., etc. There was a lot of restructuring happened, so therefore the performance improved in 19 compared to 18. Then again, I'm just leaving this. I don't want to discuss this, but there are other lot of interesting things to be discussed. But these are just figures that have got that in various categories: standard, substandard, doubtful assets, and loss. As I told you, there are categories of bad assets. Standard assets are those assets which are performing. So these are how the standard assets have moved for private sector banks, for public sector banks, for foreign banks, and the banking industry as a whole. So that I'm just leaving it for you. Then, friends, I'll just spend a minute on this particular slide because this slide is important. If you see on the left hand side, the graph which is there, the orange that is spiking in 2018 and coming down and flattening in about 2019, that is the gross not performing assets of industry. So if you see that non performing assets, the bad loans peaked in 2018 and then maybe 17, 18, and then how as far as 19 is coming and September 19, it has already flattened out. Now post this lockdown, I don't know what is going to happen. There are certain measures that the government of India has announced, certain measures that the government of India has taken, but only time will tell. So therefore there is a little bit of comfort that as far as industry is concerned, the curve has come down. But more worrying is the blue curve which we see, which is a spike which has come from 17, 18, 19, and it's going up. And those are bad loans in the agricultural sector. If you see, India is predominantly an agricultural, even today, an agricultural economy, and therefore these rise in the agricultural sector is not doing good to our cause. The curve as far as the green curve is concerned, that is for service sector, that is more or less okay, fine, it's constant, nothing to worry about that. And another good thing is that in the past few years, and again I've been discussing that, I will show it to you, is that the growth usually has come from the retail sector. The retail sector is that people like you and me are taking money not for business purposes but for consumption, for education, for housing, for buying a car, etc., etc. So therefore that is the retail section. So if you go to see that retail is particularly flat, so there is nothing more to worry about that, and that is the least impacted as far as public sector, I mean as far as non-performing assets are concerned. And therefore in the past, all those banks that have concentrated on retail sector, like for example HDFC Bank, etc., who have concentrated on retail portfolio, have done particularly good because their ratio of non-performing assets are very less. Again, on the right hand side, the graph shows that the green one which spikes are there, that is the large accounts which have turned bad. And there is an improvement in that because those large accounts turning bad has come down. But in other small and micro and medium, those figures are going up. So that is again a cause for worry. Then again, these are how private sector banks and public sector banks have shaped up. If you see on the left hand side, you have the public sector banks, and on the right hand, you have the private sector banks. The private sector banks are more than double of the private banks. So therefore, this just reiterates what I told you on the performance of the public sector bank. Friends, this does not mean that public sector banks are not performing. Yes, maybe the private sector banks are performing better, but there is certain government agenda. Government wants to give money in certain areas, in certain industries where private sector bank is not ready to lend, but public sector banks will be forced to lend money there for the for the social good of the country. And therefore this phenomena of public sector banks being less healthier than private sector banks are there. Then friends, what has helped to the recovery. If you know, India's ranking in the ease of doing business went up basically because of its insolvency act. Till today, there was no regulation or very weak regulation. If anybody wanted to be declared as bankrupt, or if he wanted to take recovery proceedings to any borrower or any willful defaulter or any person who did not want to get money, India was very low in that. But with the insolvency code coming in, this ranking of India's has gone up, and by that also what has happened is that the recovery in the banking industry has also improved. So this slide just proves that. But friends, as a practical, an insider or maybe a practical, coming with the dealing with the banking day in day out, you also come to know is that now initially the bankers used to take some decisions, but now they just wait. And then what then used to happen is that sometimes corruption charges and all used to come on these officers. But now with IBC coming, most of these banking officers say that we don't want to take any risk. I don't want to take. Let the company go into liquidation. Let it be filed for bankruptcy, and let the courts decide. So that's how is the practical difficulty in that also. Now coming to frauds again, in the last you can say in the last 5 years, the banking industry has faced about 1 lakh crore of frauds amount. And if you see, the frauds, usually the type of frauds that come are usually to do with loans and advances. That means people siphon off money, and they take away money, I mean, or maybe they take the loan for an industry for one purposes, but the end use is completely different. They give it to sister concerns. They over invoice the capital investment probably is more shown to the bank, but actual spend is less, and that's how money is siphoned. So in loans and advances, that is how it comes. Then in deposits, sometimes you have heard so many times in the newspaper that somebody forges fixed deposit and withdraws money, or liquidates that fixed deposit which was not a genuine one or the fraudulent one. So that is how the frauds are there. Forex frauds, we've already heard the PNB or the Nirav Modi case, where how in foreign exchange that frauds were or fraudulent export bills were fraudulently encashed. Then off balance sheet items, bank guarantees, performance guarantees, fraudulent, how it takes place. Then also we all know about credit card frauds and e-frauds. There's nothing in so many things comes in the newspapers. So that's how the frauds happen. And there are other areas in which frauds occurs also. Say for example, forged documents. Your particular person salary, they forge the salary slip and they take higher loans and all that. So most important, most dangerous frauds are usually the off balance sheet frauds, because that never sits in the balance sheet. And one fine day when the fraud comes, it hits you. Again, the off balance sheet fraud again would be like the Nirav Modi case, the Punjab National Bank fraud. 13,000 crores were unearthed in that, because those kept on giving letters of credit, and only until that there is a break in that chain, the liability will come. So till that time the fraud remains unearthed only. So therefore those are dangerous. But huge volume and big amount comes from loans and advances, frauds in loans and advances. The gold which has been pledged is not of the correct quantity, or maybe is not of the correct weightage or purity, etc., etc. So therefore diversion of funds which happens, okay, the fund, the bank would give a loan for capital expenditure, but then that they would buy or speculate in the foreign currency, they would buy shares. So that's called divergence of funds. As far as Reserve Bank of India is concerned, now any account that actually goes bad, more than 50 crores, there is compulsory forensic audit. And we as professionals also, this forensic audit is a new area or new opportunity of professional engagement or professional service that comes. So again, this just about what I was reiterating, from where the frauds are coming. Friends, there is also what Reserve Bank of India has done is, the Reserve Bank of India has an excellent mechanism or governance or rules as far as frauds are concerned. Reserve Bank of India has come out with policies which is called early warning signals, and they've come out with 52 criteria, that if in any particular advance or any particular borrower, if you find these particular instances, or these are the way the borrower is performing, say for example, continuously delay in depositing the money, or paying off installment, or only at the last 80th day, 89th day it's paying the money, or there are a lot of entries from within the bank, other accounts, transactions with group companies, related parties. So there are early warning signals. So therefore, you keep a watch on these 52 items which are there. So these would give early warning signals. One, if you have an early warning, or you have a suspect, or bank has a suspect that yes, these could be frauds, or there could be items of frauds in that, then you red flag that account, red flag in the system. So that means that okay, this is susceptible to fraud, or there could be a fraud in that. And after red flagging of that account, then you immediately have a forensic audit. And within 6 months of red flagging, you have to either declare that forensic audit as a fraud or as a not fraud, or release it from that. So therefore, this is a clear system that Reserve Bank of India has ordered all banks to do. And we as auditors also have to check all the system whether it takes. And there's a lot of reporting and responsibility on auditors also, to see whether this particular system of fraud happens or no. Well, the auditors would come afterwards, but first, preliminary, it is the responsibility of the management, of the board of directors, to detect fraud and to have systems in place that would prevent frauds also. So therefore, every board of director, there is a fraud monitoring committee in every bank. So therefore, they see each and every such fraud which is reported or not reported or suspected. Friends, what else the Reserve Bank of India has also done is that it has started a registry, a database which is called CFR, which is Central Fraud Registry, wherein every account which is marked as fraud is entered into that database, and every borrower can look at that in that account, in that particular bank, or in one particular borrower has marked it as fraud. Because as I told you, in the consortium banking, in multiple banking, there are multiple banking who are having exposure to that particular account. And this way, the flow of information would take place. So therefore, if it is in consortium banking, if the loan is given for one particular project, one particular asset, and if that is declared as fraud, naturally it would be fraud for all others, because everybody has lent money for that particular purpose also. So therefore, these red flagging of accounts as fraud, early detection, and within 6 months marking red flagged accounts as fraud, and reporting within 7 days of declaration of fraud, I think so these are welcome steps that the Reserve Bank of India has taken to prevent and misuse, and to also early reporting of fraud, so that corrective actions can be taken. Friends, again, this is just a pictorial a table that shows that the date on which there was occurrence, and the date on which the fraud had occurred. So if you see, there was a spike in the years wherein the fraud has been reported. And this, the next slide is sorry, this is the year of the reported fraud, the year in which the fraud was reported, as I told you. Because usually what happens is that it takes time. Some earlier it used to take 4 years for an account to get forensic audit to be done, and a banker would report a fraud after 3 to 4 years, when all the no proofs were available, all proofs were destroyed, everything had gone underground. So therefore, earlier they used to take time. So this slide shows you that the date on which the fraud was reported. So if you see, in 17, 18 and 18, 19, a huge number of frauds were reported, but those were relating to the older period. So this is the amount, I mean, this is the slide where the period on which the fraud had occurred. So there was a delay in that. So these are so this point I wanted to drive home to you. So therefore, these two particular slides are there. Then I already told you the regulatory requirement, the manager's responsibility, the auditor's responsibility. The practical difficulties which are having is that once the account, the borrower knows that there is an investigation going on against him, they don't actually cooperate. They don't, give any, have access to systems. They don't cooperate. I mean, they destroy the data which is available. So therefore, all these problems are there. So this particular slide on regulation, I've already discussed with you that what, the system, I mean, what the Reserve Bank of India, what framework it has for fraud. Now, coming to growth in credit, this is most important, as I told you. Uh, uh, the banks will do good if the borrowers do good. If people are willing to take loans from banks, banks will do good. But of late, there has been really a slowdown in consumption. People are not, there is a vicious circle. People are not consuming because the sentiment is very low. So then, um, since there is no consumption, the manufacturing is low. The industries don't, or the the businessmen don't want to invest. They don't want to invest. They don't want to increase capacities. They don't want to increase capacities. They don't want to take loans. So there is a vicious circle. So what is happening? As I told you, so far only retail loans was doing good, but now with this COVID coming in, what's going to happen to this loan growth? Whether it is going to be a challenge or it's going to be an opportunity, only time will tell. Because what is happening is people are there that people are sitting at home. you know uh, People have already got used to one particular type of lifestyle. We used to go 3 4 times in a week out, to have tea, coffee, or maybe just with friends for a movie. We used to go to the mall, multiplexes. We used to go out for dining. Will this return? If it returns, will it come bang that, since the past slowdown, in the lockdown, we've not been able to go? So will that growth return? Or all of us will become more cautious? We will save money. We will not spend on luxuries. We will spend only on necessities. Pharmaceuticals, we'll spend more money on healthcare. So will the healthcare benefit? So therefore, it all depends on what happens is. And plus, the main reason also for slow growth rate was, fintech companies and NBFCs was a strict competition for banks, because they are also into the same business. See, if you want to go and buy a washing machine, you buy an air conditioner, a computer, you have a bank who's giving you an offer also, and you have the Bajaj, FinServ, and all those NBFCs also giving you a loan. So therefore, and these were just, now that loans come in 10 15 minutes. You just process your salary slip, you upload, and that money is sanctioned. And that also, that money does not come into your bank account, that directly the bank or NBFC would transfer that money to to maybe a Chroma or something, and definitely you will be delivered the goods, and the loan is there. So therefore, this slide shows that, the growth has come down, which had peaked to about 25% growth of loan in about 2010. It went in December 18, again it went to 15%, but again it is 7% as of December. And now, of course, it's times which are, these times are not comparable. These are extraordinary and exceptional circumstances. So therefore, growth rate now would not be comparable to this. But of course, before we went into the lockdown, as it is, I told you, our economy was sagging. Our economy was not doing good. It was, situation was bad. So therefore, this just, this graph just shows that the growth rate in December 17 had fallen to about 7.5% from 15% in December 18, in 1 year's time. And this is only industrial growth. That was overall growth of 7%. As I told you, a lot of growth came in from the retail sector only. And here, if you see, the growth has been only 2% in the industrial, where actually the big ticket growth should come. Then this is a frightening slide, friends, here, which I want to show, that the bottom chart which is there, it shows the consumption. The consumption is going down, and the lending growth is going up. So therefore, that gap, so if people are borrowing but are less consuming, where is that money going? Whether India is going to get into like a 2008 situation that happened in the West, are we going to fall into this particular situation? So therefore, this gap, so unless and until the consumption it goes up, this particular issue would be a problem. Then, friends, if you see the concentration of loan, the growth, if you see the concentration, the extreme left hand side chart shows that the growth is only coming from very large borrowers, the 5,000 crores plus type of borrowers. So therefore, if you see, in 2018, they constituted about 15% growth. They grew by 15%, and they have grown by about 29% in 2019. So these are the big ones. But the small, medium, and the large ones are not taking there. In fact, if you see, see a fall in all these businesses. So there is a limit to which large businesses will grow. And as you know, the small and medium again are a backbone, or again are majority of the contributors to the economy. So therefore, you would also require these particular, the SMEs to do good. Then PSUs and private, if you see, as I told you, PSUs were willing to give loans. The private banks were not willing to give loans. So therefore, they have got degrowth. If you see private sector here, since they had burned their finger in a lot of bad loans, a lot of frauds. So therefore, people were wary of giving loans. People did not want to give loans. Even the bankers had become become over cautious. Even though the bank's mandate is to give loans, but they were not taking the risk. The particular business of bank only is to take risk and give loans, but private sector banks are not doing it. And even public sector banks now, with all the situations, maybe some government policies, slowdown in economy, all various reasons are there, which is are lending to the slow growth of growth rate in taking loans. Now, this is very important slide. If you see on the left hand side, if you see uh, in 2012-13 is the inner circle, and the outer circle shows the sectoral distribution of credit in 18-19. If you see, the blue is agricultural, is more or less remaining same. If you see that orange curve, that is the industry that has come down. It was more than about almost like 50%. It was there in 2012-13, which has gone down to about one third, or maybe about 40% in 2018-19. And what has gone up is service industry and retail. If you see, retail has almost like doubling. In 2012, retail was not there, but the distribution has gone up in 2018-19. And coming to the right hand side again, within retail, now this is the classification within retail. If you see 12-13 and 18-19, the blue curve, almost 50% of the total retail loans is housing. And it is but so, because in India we all are very sentimental about owning a house. It's important to own a house, unlike the West. And unlike the West, they just hire a house or rent a house and they stay. But in India, it's a very social, it's socially important to own a house. So therefore, more than 50% of the retail loans came from housing only. Then if you see the orange curve as the personal, that is almost doubling for other reasons other than vehicle loans. So therefore, other people are borrowing for other than agricultural, educational, vehicle, all those remaining almost the same. But for other reasons, personal clean loans, people are taking the money. Then capital constraint. Friends, this is important. As per the regulation, not only by Reserve Bank of India, but also foreign banks have certain restrictions that, okay, if you have a particular business, if you're, a particular size of assets, at least some percentage of that should be your capital. So therefore, just to explain in layman's term, suppose if a bank has got risk-weighted assets, RWA, of 100. So that means my investments, my investments that I'm holding, the loans that I have given, the money that I have blocked in my furniture, in my office, if that is 100%, at least my capital should be at least 10.5% is what my tier 1 capital should be. And capital would mean paid up share capital and reserves. And my tier 2 would mean also government of India has also introduced perpetual bonds and tier 2 bonds. So they mean these are like loans or investments which are like capital, are not going to get redeemed. It's going to be like a permanent capital for the banks. So therefore these are called the capital tier 2 capital. So therefore if the current requirement is of 10.5% tier 1, and which includes tier 2 also. Tier 2 is about 8%. So as I mentioned you, PCA, preventive correction action. So if your capital goes below these threshold limits, then the Reserve Bank of India will come out with sanctions and restrictions that you are not safe enough. Because suppose if something goes wrong or some assets goes wrong, some loans go bad, you don't have enough capital to survive, enough capital for your bank to survive. So therefore capital constraints are always there. In public sector banks, they require capital to survive because their earnings is very weak, or the quality of their earnings is weak. And private sector banks, as I told you, they have grown phenomenally. So therefore, to grow, if you want to grow by 20% every year, your capital also needs to grow up. So therefore private sector banks require money for growth. So therefore, this is what I wanted to discuss, that, okay, these are also challenges because money does not grow on trees. I mean, even if the government wants to invest, as I told you, majority of the banks, the big, large section of the bank is of the banking industry in India today is public sector banks, and government only supports public sector banks. So therefore, there is a restriction on capital. Uh, uh, Private banks, easy to raise money. Capital adequacy, I've explained to you, that is the amount of percentage that they require. Provision coverage ratio, what I've told you is that, okay, if the loan is 100, bad loans are 100, and if you have a provision of 50 rupees, then your provision coverage ratio would be 50%. So higher the provision coverage ratio, the stronger your bank is. So with these, I'm leaving you with some graphs over here. If you see the spike in orange ones are the capital that is in 2019, and in 2018 the capital which I have given. So therefore, if you see in cases like Corporation Bank, in cases like Orient Bank, Andhra Bank, all capital has been infused by the government of India. So therefore, this is how they have supported. And if you see State Bank of India, the percentage of holding also of the government is very less, because it's a more forward looking, more bigger bank, more stronger bank, the biggest bank in India. So therefore, it is capitalized on its own. There are a lot of foreigners holding, mutual funds holding in there. We invest more in these stronger banks. So therefore, they don't require, the challenges of State Bank of India are different, but the challenges of all other banks are different. So therefore, then again, this is the amount is, since there is, we have to rush and we have to leave some time for question answers also. So I'm not going to take you through this, but this is the amounts of money raised by private banks and public banks. This presentation will be shared. So you can, the organizers will email it to you, or from the website, it will be available. Then again, these are the tier 1, tier 2. If you want, if you can see, in 2019, where the requirement was 10.5, the statutory requirement of 10.5, the public sector banks had got about 10.8 on the left hand side, and about 15% of the private sector banks. So they are much more better capitalized, they are much more stronger. This is provision coverage ratio, which I told you. Here the public sector banks are much better because of the the NPA issues that they had, the larger accounts which they had. So they were keeping on having additional provisioning. But this will definitely change in 2020, and particularly moving forward 2021, this will provision coverage will change. Friends, coming to future trends and what is going to be, the future of banking. There's going to be a big, already now from 1st of April, already the Reserve Bank of India has announced these mergers. So what is happening is that from 18 public sector banks, now we are already down to 12. The intention of the government is not to have competition amongst the banks, because they are all government banks, to have bigger banks, to have stronger banks. Then how will the IBC process full succeed? How will the insolvency and bankruptcy code succeed? So far it has got good success rate, but the process is a little bit slow. How the government will invest in the infrastructure will be in time to tell. Then from here, from where the growth will come, and all this is in the time where this all was discussed before the lockdown, before the COVID issue coming in. But now all these challenges will remain. And how will technology, new breeds of banks are coming, as I told you. These smaller banks, my son is just transferring money from here. My father is playing housey, sitting at home, he's transferring money from his bank account to play that housey. 100, 500 rupees are transferred like that. So what will be the role of the traditional banks that are going to happen? How is technology going to change banking? What is going to be the future trends in banking? Friends, I'm just leaving you here with this is publicly available information, that which bank will become strong, what is going to be the size of the banks. From 27 earlier, then State Bank of India, all the subsidiaries merged into State Bank of India. Then in 2018, we had the biggest merger, wherein Vijaya Bank merged with Baroda, Bank of Baroda. And then now, after on 1st of April, you have these mergers over here, wherein Orient Bank and United Bank are going to get merged into Punjab National Bank. So Punjab National Bank is going to become the second biggest public sector bank. Canara Bank Syndicate is going to get merged with Canara. Andhra and Corporation are already merged today. So today, if you are having an account with Andhra or Corporation, that bank does not exist. It has got merged into Union Bank of India, and Allahabad Bank will get merged, has already got merged with Indian Bank. So this is the this thing. The new order of the ranking no doubt State Bank of India will remain the biggest bank with a 22% share, 22.5%. Punjab National Bank will be will be a distinct second, and HDFC Bank will be 7.6. So there's a close race between second, third, and fourth in percent in market share. Now, as I told you, payment banks, I explained to you what payment banks were. Then small banks also have told you that they don't get into big, large corporate banking. They just get into personal banking and small ticket loans. Microfinance is again, which I want to just explain to you, and I'll just take 30 seconds in explaining microfinance. Microfinance is very important as far as banking industry is concerned, because as I told you, typical problems in India is to reach, rural economy, to reach farmers. So therefore, these community, these farmers, sugarcane growers, like an example, they form a small group and they contribute money. And within from that money only, they have microfinance. And somebody wants to take loan, it's like a, formalized type of VC. Don't call it VC, but this is a concept which is there. But this is a more formalized microfinance, and government and Reserve Bank is encouraging them so that to reach to the final beneficiary. So therefore it is there. Then you have a concept of bad loan which has come. So Reserve Bank of India is planning a loan, a bad bank, wherein all the bad banks will go over there, and there will be a systematic approach to how to handle this bank loan. So there will be a focus on bank loan. Then of course e-wallets and mobile banking. Already I have told you how artificial intelligence and how is going to impact. Friends, I just want to leave actually this is a fact with you. Traditionally what has happened is that when today you go for a loan, the bank traditionally today asks you that, okay, what is your income tax return, how much is your income, what is your balance sheet size, what is your net worth, where have you invested, do you have a house of your own, what is your salary slip. All these are the loan criteria. Friends, now moving forward, all data is available digitally. Wherever you are moving, your phone data is available, your wherever you are spending, that is all available. So moving forward, the loan giving of the loan is going to depend on that. Your credit score is going to depend upon your social score. Just now you have a credit score, it's going to have a social score. Your social score will depend upon your habits, how you are living in society. Say you have, say if you are a family man and you go to a restaurant, usually at 9, 10 o'clock you will type your bill, and a hotel bill, and that will be your social score. But if you are visiting pubs and you are swiping your credit card at 2, 3 o'clock at night. So that means that impacts your social score. If you are seeing what type of movies, what type of downloads you are doing, what type of shopping that you are doing, it will depend on that. And along with that will also happen the prevent, how you have your, how you handle risk. With all this will come with electronic, it will come how a different type of frauds, new type of frauds, and whether a bank will remain relevant or no is what important it is. And this was an interesting study that had happened, which said that 100%, it showed that financial literacy, financial maturity, and the digital maturity, we all would like to be in the top 16%, which says that it has financial maturity and digital maturity also. And nobody would like to be in the 36% of the people, wherein digitally also they are low matured and financially also not very matured. But usually India is now usually moving towards digital literacy and electronic this thing, and financial maturity also will come one fine day. So this is future trends is what I have explained to you actually. And now, friends, just last 2 minutes, I will just explain to you what has happened recently. As I told you, the importance of banking industry can be seen immediately after the government announced the lockdown. Immediately within 2, 3 days, the government announced all the deferment of the taxes that you could pay later, the advance tax and TDS, and all those due dates got extended. And on 27th of March, immediately it came out with, the RBI came out with a press release. The RBI came out, the governor came out with a press statement and giving all these various concessions and taking these steps to increase liquidity in the market. So therefore, this is the importance of the banking industry also, that these steps were taken. And this immediately it was, the press release that the Reserve Bank of India came out gives the importance of the banking industry, which is there. It took measures to improve liquidity in the system, so that more money could come in the hands of the people, so that money could roll, and there could be impact on the economy could be less to that extent. Then it gave regulatory and supervisory changes, wherein it did was that it gave moratorium to all term loans. It deferred the interest and payment. So this was discussion that, okay, all those loans, all those installments from 1st of March till 31st of May were not required to be paid, and they could pay it after 1st of June. And we are also expecting that this moratorium to increase, so that 90-day period they gave, that it will not be counted, as a restructuring. You could defer your payment of interest and installment. Then they also came out with easing of working capital facilities, that okay, you read, you reassess the working capital cycle of that borrower. You reassess the drawing power. If that person requires additional working capital funding, you give them. Then other stringent regulatory matters were deferred. They also took certain matter or certain steps to improve the financial market stability. And it came out, then ultimately on 17th of April, it came out with a very welcome circular, wherein that all this deferment, if a borrower has taken this moratorium of 90 days, don't classify them as bad assets. So therefore that improved the financial position. But it came with a caveat that you require 10% additional provisioning on these loans, which would have fallen bad but has not fallen bad. So I think so these were the welcome steps. And these were, just giving a highlight of, the banks which have, the percentage of advances which are under moratorium. If you see, again, as usual, the Bank of India is just less than 10%. I mean, all the borrowers, if your advances is 100, then less than 10% of the borrowers of HDFC Bank has taken that moratorium. And the highest is amongst one of the RBL Bank. ICICI Bank is more than 30%. So therefore that shows that they have more corporate loans. So this is what I'm left with you. And also on as late as 13th of May, there were a lot of measures that Atmanirbhar, wherein a lot of concessions have been given to MSMEs or to micro, small and medium enterprises. And these are the list of facilities that are available, that additional loans will be given to handle stress assets. Then also free loans will be given, collateral free. So there was no requirement for security for 4 years for those people who have borrowed for more than 5 crores and less than 100 crores. So therefore there will be no repayment for 1 year, and interest will start only, interest will be charged, but no repayment for 1 year, and this 4 years loan will be given. So, and with this, I think so I would just like to come to the penultimate slide of my presentation, which talks about the 10 most important brands that you can see in India. And out of the 10 most important or most valuable brands, you can see that 4 are banks. And the first topmost in brand value is a particular bank. So therefore, this is the importance of the banking industry in India. This is how the banking industry goes. And friends, I would just like to leave it the last slide, that, okay, we have so many banks in India, so many, well-performing banks in India, but yet we don't have any bank which is only one bank of India is there in the top 100 banks of the world. And as China has got 20 banks in the first top 100, and US has got 10. So government is taking steps, but I think so with these words, I think so I would like to end my presentation, leave some time for question and answers also. And I hope, this was not an expert session, but it was just an insight where everybody of us as a banking industry, we take services from the banking industry, from the banking services. So it would just help you have an overview and little bit of insight on what are the challenges, how the bank works, what is the future of banks, and how the banking industry is going to follow. Thank you very much.
Thank you, sir. So we'll start with question answer session.
Yes, yes.
So first question is, with the infusion of credit by the government over past few days, what is your take on the performance of the banks? Keeping in mind the banks are already cautious about lending even before pre-lockdown.
See, before pre-lockdown also, a lot of, as I told you, a lot of concessions were given to the banks. And the banks were allowed to give to NBFCs, because NBFCs also are part of the same, economy. And where all NBFCs also give for housing finance loans and all that. So therefore, it is equally important. And a lot of provisions were given to the banks to give to these housing finance companies and NBFCs. But banks have become so cautious. Today, if you see, banks are flushed with money. Banks are flushed with money. They have got money. Their balances with the Reserve Bank of India have increased. They are not, in fact, they are very averse of giving loans. The actually the purpose of the banks is to give loans. It should give loans, but it will be very, very cautious, I think so, because the cycle is so vicious, because once the loan turns bad, uh, you know the banker's job is also very difficult, because then it has got all the investigation on it. All the investigative agencies sit on their head and they ask a question. So today the banking job is very, very delicate. Yes, they need to give these loans. According to me, this is the best that the government could do to infuse liquidity. It is only up to the bankers how discreetly they will give the loans and how much of them will go bad. But my personal view is that yes, the banks will stand up. Maybe the private banks will be very selective, but the public sector banks will give loans to deserving cases, and we will have a spike in NPA also, and we should be ready with NPAs going up also. And also to this, I would also like to add is that the sentiment, I mean the typical mentality of Indians. I mean, today the Indian industry, okay, yes, free mein mil raha hai, so let us take it. So let us take that even if you don't require that, but people would take, and they would be always open to misuse. So I hope all these things don't happen. But yes, I feel banks will be forced to give, and we should be open to a little bit of bad debts also.
Okay, next question is, how loan in 55 minutes affect the credit market?
In my view, it is a publicity gimmick. I have never come across anybody getting a loan in 55 minutes. It's only, even if you see private sector banks and public sector banks and everywhere, they say that, okay, you're going to get a loan. But I would be happy if somebody would come to me and say that, yes, I applied these papers online and I got the loan. And in 55 minutes, your accounts and all will be, documents will be uploaded, and that loan processing will start. Unless and until you have your, I don't think it impacts a credit rating at all. Your credit rating would be impacted by your repayment history, your repayment schedule. How are you adhering to your repayment schedule? Then your credit rating will improve. But I don't think taking a loan in 55 minutes increases or reduces your credit rating.
Next question, is availing moratorium on housing loan, whether it's good impact on customers or not?
Yes, definitely it will be good. Say for example, but my advice is that if you have liquidity, if liquidity is not a problem, then do not take use of this moratorium, because the interest does not ceases. You continuously keep on charging your interest. So that interest meter keeps on going. But if you feel that you want to keep you want some money for some other requirement, you don't have liquidity, and that part of your housing loan you don't want to pay, and you want to keep it for some meeting some other medical emergency or education requirement, then only use the moratorium. Otherwise, don't use the moratorium. And in this, what happens also is that they say that, okay, 3 months moratorium will not be used. But ultimately, with the interest going up, it does not mean that, okay, if you have taken a loan and you have 57 installments pending, then you will have to pay 3 more and 60 installments. No, but by number, the installment amount remaining same, maybe 4 or 5 installments you'll have to pay more, because your interest will go up. So my advice is that if you have liquidity, don't take the benefit of the moratorium. If you want to preserve liquidity, then you take this benefit.
Next question, does fintech promote synergies and alliances as an opportunity for developing truly digital financial service market?
Yes, definitely, I would feel so, because fintech companies definitely depend upon these high tech tools which are available. And also, if you see now, you see all these technology companies, they are getting into it now. Geo is a technology company. Airtel is a technology company. They have gone into this banking. They have gone into this. So it will be a big synergy, and it will definitely integrate the full process, and it will be help. It will lower the cost, and more inventions will come out. More newer products will come out.
Next question, will mergers affect employment opportunities, whether it will reduce or increase?
It's a good question. Definitely, I feel my limited experience that many of the public sector banks are doing social service also. They are engaging people who are actually, had it been a private sector bank, these people would not have been employed. So therefore, already there is a waste of cost there. And definitely with use of more technology, with use of core banking solution, with merger of banks, the staff will lie redundant. But by government cannot announce this, that okay, the staff will be redundant. So maybe there will be disguised unemployment. People will be not asked to be retired, but maybe a voluntary retirement scheme would come after things get normalized. But yes, definitely in my view, there will be surplus of staff. Opportunities, no. Private sector and yes, private sector and new age businesses and new age companies will have employment opportunities. But as far as public sector banks, increase in employment, no. But yes, definitely chances of people getting disguised unemployment would be there.
Next question. What is relationship between forensic audit and banking sector?
As I told you, relationship in the sense, there is no relationship as such. Only like how banks take our services for audit, bank takes forensic audit service also, because banks are not in a position to do forensic audit, not to do detect fraud, or not to go deep dive into the fraud. Of course, they might be knowing, but these forensic auditors are experts, wherein they use their expertise, they use their knowledge, they use their degrees that they have got by doing forensic audit, and maybe pinpoint that yes, this is the fraud and this is the quantum of the fraud. That's the only relationship.
What will be the role of banking sector after COVID period, once everything is normal?
I think so. It will be most important, because as I told you, if economy has to grow, economy has to come up back to its feet, it has to stand up. The banking industry has to play a major role. And as I told you, there's a unique feature as far as India is also concerned. It has public sector banks. So public sector banks are also an extension of arm of the government only. So if government wants to come out with some social security, wants to come out with some social, initiatives like this Jan Dhan Yojana and Mudra loans and all that, it will be through these banks only. So banks will be definitely important as far as bringing the economy back to shape.
Sir, is there any new Basel norms coming up?
Yes, there are already Basel III requirements, but that is kept on hold because just now the government does not have money to infuse, because Basel III are much more stronger, much more stricter, and it will come once a little bit stability comes in the banking industry. Then India is bound to have these. But as far as this thing is concerned, I also want to make one point very, very clear: is there's nothing to fear. These are so many rumors, and I'm the one who feels most disappointed when I get a SMS from a friend or phone call, अरे ये बैंक का ये सुना, ये बंद होने वाला है क्या, ये बैंक बंद होने वाला है. Don't put your money in cooperative banks, put your money in good scheduled banks. Even in public sector banks, they are not going to. You see what happened in Yes Bank. They also, it was the the bank that went bad, the loans that went bad. I don't want to comment on the management because I am no expert, I have no idea on that. But maybe the loans went bad, so therefore be careful on where you are. Just sorry, what was the question you said? Because I just this thing diverted. Your original question was? Hello.
Yes, so whether new Basel norms are coming, like Basel
That
4?
that I told you, no, that I told you.
Yeah, yeah.
Okay.
Okay.
On extension of that, I told you that there's no fear that just because that Basel III we are not adopting, our banks are much more stronger, very well regulated. It has withhold a 2008 meltdown also, and it will pass through this also. No bank will collapse in this situation.
Okay. Sir, kindly, can you provide us some information on concept of Islamic banking and its reach in current banking industry in India?
Not much, because that's a unique concept only in the Gulf countries and in the Islamic states, wherein they don't have the concept of concept of interest. So therefore, what they go on only sharing of profits. So suppose if the borrower has made some profits, that's the way how they share the profits. But I don't think so. That's a concept that will be very popular, because that's not very popular in the other part of the world also, and India also. It will not be that popular.
Sir, can you elaborate on how banks are fully regulated by RBI, as every bank is creating its own rules regarding minimum balance and charging their own interest rates?
See, it is a broad framework that Reserve Bank of India has given. It has given that full flexibility that within this framework, you set your own rules. So therefore, these rules regarding minimum balance and all, it all depends on, say, for example, now today, there is no regulation, or there is less regulation on the amount of savings interest rate that they can give. Today, these, small banks and these private banks which want to encourage deposits, they want to encourage CASA ratio. CASA is the current and savings account. These are the low cost deposits that they have. So they give higher rate. Bank like an HDFC, ICICI, State Bank of India, who are more, they have loyal customers, they will give a less rate, because just for that 1 or 2% interest rate, people are not going to shift loyalties. People are not going to shift the, people would look at go at a stronger and an old brand name and a good brand name also. So therefore they will have different, but within the broad framework, the rules, different banks will have, otherwise what's the fun, you know? I mean, if you have all the banks offering the same type of services, the same, then probably then you would go, okay, Union Bank of India has got a red and blue, so I like red and blue, I'll go there. Punjab RBL has got, I like the HDFC logo, so I'll go there. That's not the case. So you require that banking experience. So therefore, you know, you these within the framework, broad framework, you are allowed to form your own rules and regulations. But yes, you can't break up that framework. You cannot go beyond. Say for example, like a bad loan is there. You cannot say that, okay, my performance is better, so therefore I will start recognizing loan only when it goes bad after 120 days. No, that the rule is that 90 days means 90 days. You know, it's that way. So therefore, these are, you know, the free hand that has been given to the bank, and within this free hand, they form their own rules and regulations.
The last two questions we'll take. There are many questions, so due to
Sure.
time constraint, last two questions.
Sure.
So public sector banks are providing a lot of amount for SIC units, and can't they adopt restructuring strategies? Because these SIC units will not be able to repay the whole amount.
See, I have always believed that whenever the account goes bad or the account becomes NPA, it's because of 3-4 main reasons. One is the intent of the borrower himself, that his intention only was to defraud, and he wants to fraud. He wants to, you know, defraud, and intention only was not good. Second one is an incompetent promoter. That okay, his intentions were good, but because he was incompetent, he was not able to deliver, and he didn't have execution skills, the amount went bad. The third type of borrower would be that things went beyond his control. Say, for example, a situation like this, or there was a strike, or there was a fire. So therefore, according to me, you need to support those people who are in the two categories, the second and third. The first category, yes, the intention whenever, and the bankers are much more smarter than us. They know what the intention is. It's not that they don't know, because they are dealing with these type of people day in, day out. We don't deal with this type of people day in, day out. So therefore, it is important to support the second and the third category, where there are chances that the patient will come out from the ICU, get into the general ward, and ultimately it will become healthy. But those people who are on ventilator and who are on dying stage and is, you know, just sick, I don't think so. You should put good money for that bad money. So that is how it is. So it has to be very case to case basis. You have to take a decision on a case to case basis, and definitely the work of the bank is to support, but not at the cost of the bank, the loan becoming bad. So it will be a very case to case basis, case specific.
Okay, last question, sir.
Yeah.
Sir, don't you think banking bubble is started in India because today people have fear of depositing money in bank because of cases like PMC and Yes Bank, and it's our hard-earned money.
I know, but I think so. I've just addressed this in a lot of question answers also that I've addressed very predominantly. I've said that no bank is going to fail. Don't worry. Don't put your money in cooperative bank. That's what my advice would be. Yes, Yes Bank, people put the money, but bank has not got bad. I mean, there is now restrictions were there for a few days, but that restrictions were lifted. Money was kept in Punjab National Bank, but the borrowers have not. I mean, the people who have deposited have not lost money. The bank has lost. The government has supported the bank. So I feel we as educated people should not come in these rumors. Yes, if you go to an XYZ or maybe a Mumbai City Cooperative Bank, you know, these cooperative banks and all, there are certain cooperative banks also which are strong enough. But we should not be spreading rumors, and there should not be unnecessary fear. These front-ended banks, scheduled banks, government has support. Government will not allow this to happen. So I think so. That's only my submission.
Now I would invite our my colleague Dr. Pratiksha Patil to deliver vote of thanks.
Yeah, thank you, ma'am. Am I audible?
Yes.
Yeah, I, Dr. Pratiksha Patil, propose vote of thanks on behalf of Band Sangha's Uma Krishna Shetty Institute of Management Studies and Research. I would like to thank our President Ban Sanghas Shri Padmanabha Payade and our Higher Education Committee headed by Chairman Shri N. Vivek Shetty, our Vice Chairman Shri Kishore Kumar Kutiyar, our Chairperson, Vice Chairperson Srimati Mamta Shetty, our Secretary Shri Bhaskar Shetty, our Treasurer C.A. Ramesh Shetty for their immense support towards growth of our institution. I take this opportunity to thank today's esteemed speaker, C.A. Manish Sampat. Sir, it was indeed a great session. There was lot of takeaway for us from this session.
Thank you.
Thank you so much, sir. I would like, I would like to thank our participants from all the fraternities. Once again, thank you everyone for your cooperation. Stay home, stay safe. Thank you.
Thank you.
Thank you, sir. Thank you so
Thank
much.
you. Thank you very much. Thank you for having me.
Yeah, wish to see you in college.
Yes, yes.
Thank
surely,
you, sir.
surely,
Thanks a lot.
surely. Thank you.
Everyone, we have posted feedback link on YouTube. Please fill that feedback link from your Gmail account to get certificate. Thank you, everyone.
Shalu ma'am, you want to say something about your next webinar?
And PET examination. So we are going to provide different strategies for 3-day session will be there on paper 1 and paper 2, commerce and management. So anyone interested, you can ping us and we will we'll provide all details on our WhatsApp group.
Shalu, please repeat the dates because you are inaudible in the start.
Okay, our college is organizing next webinar on 20 to 22nd May, and it's regarding examination strategies on NetSet. We are going to provide different strategies on paper 1, paper 2, commerce and management subject. You will post all information on our WhatsApp and Telegram group.
Okay, thank you so much.
Thank you.
Can we stop YouTube live feed, please? Hedoy?